Hey, this is Sasha, and welcome to another episode on Hungry for Returns, where I answer your trading and investing questions here in video format that's a little more detailed than just writing back an email. So if you want to submit your question by voice or writing a question, take a look at our website at tradersfly.com and go ahead and submit your question, and you might be featured on the show. With that being said, let's take a listen here on our next question, which is related to in the money, out of the money, and at the money options. So let's take a listen.
Hi Sasha, this is Greg. I was wondering which is the best for day trading options without leaving any positions opened overnight. Would it be out of the money, at the money, or in the money? I believe it's at the money, but I need your knowledge and experience on this. I really appreciate it. And that's about it on that question. Thank you. Second question. I was wondering if they have any software yet that allows us that don't have a whole lot of money to be able to sell options, calls or puts. TD Ameritrade basically says you have to qualify or own the stock. Well, that defeats the purpose. Please help me out. I was hoping there was a software that I know that there's a cap. Your credit is only what you can make. I was hoping there was also maybe something new out there that allows it to stop also when it goes against you. I know that's why they don't want us to play those, but they're awesome when I paper trade them. Again, thank you very much.
Okay, so let's take a look here at this question and break it down into, you're probably looking at single options when you're talking about these things between both of these questions. And really it comes down to they have different advantages. If we look at Amazon here, I like using Amazon just because it has a lot of strikes. So you could apply this to any stock. When we look at the money, it's basically looking right at that price where that stock is trading. It's 1,896. So it's right around there, 1,895. You could even say 1,900. But you're not going to get it exactly, right? So 1,895 is really at the money. It's at the money. It's right there, very close. If you go in the money, it's anything here in blue, which you could say is 1,800, and out of the money would be way out here. And the main difference is that it comes down to expiration, and that's really what it means, and the delta, the amount of delta. But if you're day trading this, it doesn't really matter. Right? So if you're just day trading these, it does not matter that much on which one is in, out, at the money, or out of the money, except when it comes to the delta part. And this is the big difference. So let's look at the money part, which we're going to get at the 1900. So I'll just put it at 1900 because it's 1896, so close enough. So here, we'll take a look at the 1900, and what you're looking at here when you're day trading these things is, you're looking at the delta, and the delta is how fast it moves as far as your profit goes for a $1 movement in the stock. So if I look at here, we have 52 delta. So let's say I offset this by a stock goes up $1. Well, look at my profit margin. It's about 52. It's not exactly, but it'll move in 52 increments. Let's go to $2. You can see we went to $92 in profit. So basically, initially, that first one is not going to work as much because you're starting at a negative $12 for the bid-ask spread, okay? So your delta is at 52 at the money on this one, okay? If you go out of the money, okay, your delta is 15, so it's much less. So it gives it a little bit of more cushion. If things go against you, it doesn't hurt you as bad. But if things go for you, it doesn't help you as much as well. So let's look at here a $1 gain right there. You can see you're still down $9. Okay, let's go with a $2 gain. Now you're up $5 because remember, bid-ask spread. If we started at 0, we're down already $25. Okay, if we go up $3, now we're up 20. So now you'll see again, we'll probably jump to about 35 because we have a delta of 15. So 20 plus 15 will be about 35 if we change this to a 4. So there you go. You can see it's 38 as the price is wiggling. So that's really what it comes down to, is that now prices are a little more soft, okay, for you, whether they go down or whether they go up. And if you go in the money, okay, you're matching the stock much more. So you have a delta of 0.71, really 71. So here, when you're looking at this now, for every dollar move, it matches the stock much more closely. So if you're trying to match the stock and you're trying to day trade, typically most day traders will go way in the money, but not too far to the point where you're not illiquid, right? So not to the point where there's less liquidity, or let's just say not a lot of contracts. So you wouldn't go, let's just say, to the 780 or the 800 maybe, but you would try and go maybe to, let's say, the 1400. There's 110 open interest there, maybe 1460. So you try to go deep in there, and that way it moves very closely to the stock. So that's typically the approach most day traders would do with options. As far as your second question goes, is when you're doing these things naked, let's just say you're selling, whether that's a put or a call, no, there's no broker out there that's going to do this for you, because let's just say the stock files for bankruptcy, which the chances are very, very slim, but you still have contracts and obligations and risks that are involved legally. And if these all of a sudden drop down, you're going to be owing, let's just say 50 grand, 80 grand. And if you only have $2,000 in your account, you know, the broker's going to lose out because they're never going to collect from you. So no, they won't let you trade this. So instead, the better approach is learn to trade vertical spreads, like we've done with our Iron Condor course, our vertical course. So if you learn those things, like let's just give you a setup here. Now you cap off your losses and your wins. Okay. Now you cap off your wins, but you also cap off your losses, and that allows you to trade the spread and the stocks and still collect from the theta. And you can position them in different ways. You can position them to the upside or the downside, but that requires more knowledge because now you're doing multi-leg spreads. But as far as brokers go, you're not going to find that anywhere because nobody's going to give you kind of a freebie loan that if things explode, you know, they're not going to get anything from it, right? So anyways, so yeah, in the money, out of the money, at the money, typically you'll go deep in the money. But again, if you want a little softer kind of movement, then you'll go a little bit out of the money. And it just really depends on your capital amount. So I hope that's helpful. It gives you some insight to the perspective of where to trade for day trading single options. But just be very careful with the volatility. It's going to give you a little more wiggle room on your profit and loss when you're day trading options. Anyways, thank you so much for joining me. I hope this was helpful and insightful. And if you have a question, be sure to submit your question by clicking the link over here or get on our newsletter list. But if you want to just hang out on YouTube, then just subscribe right there, and that way you get notified as we release new videos. Thanks again, and I'll see you next time.